Of course, it is the first Friday of the month, and that means, of course, it's non-farm payroll day, US jobs, and fascinating data coming out of your part of the world this afternoon. Jobs growth weaker than expected last month, certainly raising concerns that the USA is starting to stumble under the weight of those very long-term higher interest rates. And we'll talk about those rates and what that number has done to what we think the Fed is going to do in a couple of weeks' time. Employers added 142,000 jobs in August. That is less than it's about 160,000 that analysts had forecast. Nick, how have markets responded to that news today? And the important question is, how much has that affected what we think the Fed is going to do?
Yeah, Johnny, it was such an interesting report, and you hinted at a good starting point there, right? So we were forecasting 164,000 jobs. What actually came out is 142,000. So a miss on the jobs added front. And to some people's surprise, myself included, the market actually jumped up on this number initially, which may have been confusing. But then when you look at the unemployment rate, I think there was probably some fears baked in there that, unemployment rate's been on the rise. Previously, it came out at 4.3%. So maybe there was a little bit of a relief, pop in the stock market simply because, and same thing with the dollar. So the dollar in the stock market popped on the opening, opening run on this data point. And maybe it's just because unemployment rate actually came down. We saw 4.2%. So maybe some of that fear was offset by the lower than expected unemployment rate. But the good news kind of stops there, Johnny, because when we take a look at what you mentioned, the 142 compared to 164, that tells half the story, which is a not great start. But it's the revisions. The revisions really caught my eye, and probably a lot of investors' eyes as well, because previously, if listeners remember, we saw the jobs data point come out last month cause a big slide in markets globally. We saw the Japanese yen get very strong. We saw global stock markets sell off of the fear that, okay, we might have a hard landing here on our hands. Jobs data is really sliding. Well, not only did the number today miss for the reported number for August, but they actually revised that 114,000 jobs missed from last month. They revised it lower, down to just 89,000. So you're talking going from triple digits down to double digits. We missed really big on the last report. And then today we had another miss. And that just adds on to the story of this week, Johnny, which we've been covering, which has been JOLTS came in very poor, all right? So job openings very light. We also had ADP yesterday come in light. So you take a look at the full picture of the U.S. labor market, and I think it's fair that concerns have steadily risen about how soft is this landing really going to be. So I think that it is not necessarily all doom and gloom. Like there's still the chance that you do see the economy kind of hold in there. There's some spots of strength and some spots of weakness, but I would say that the labor data has surprised us to the downside this week, and rightfully so, has increased a little bit of the worries about how soft this landing is going to be. There's a side note here, Johnny. We're getting closer to U.S. elections, and we know that can cause fear and uncertainty for investors big time.
Indeed, I'll talk more about that in a second or two. But where we were a few weeks ago, Nick, is we had a succession of contradictory data, didn't we? Where you'd have, on the one hand, we'd have the whole bad news is good news and good news is bad news scenario. But now it just seems we've just got bad news, more or less, particularly when it comes to the jobs. You said that there are some reasonably positive aspects out there, but with all this jobs data combined, that has certainly felt, for me, a real precursor to what we think will probably be a 50 basis points cut in September. We talked about this a few days ago, and markets were about 50-50 on the 50 basis points cut. Where are they now?
Well, surprisingly, Johnny, they haven't moved too much. And we can kind of get a better picture from that when we take a look at the dollar index. The dollar index today is lower than when it started the week, but higher from the lows. It's made a nice bounce back from that 100.5, let's call it, give or take area. And I think that, when we see the big slide in the stock market, there's a possibility that you do still see that 50 basis point cut or 25 basis point. It's very up in the air. In fact, it may surprise you and listeners that the expectations, according to the bond market calculation on the FedWatch Tools website, or the FedWatch website, it's actually still about 50-50. So, but we got to think too, Johnny, a couple weeks ago, what was it? It was like 75% chance that we would see a 25 basis point cut. So I think that, as I mentioned earlier about how I think it's kind of rightfully so that suspicions on this soft landing idea have risen, we also see that reflected in the expectations for this upcoming Fed meeting on how much they're going to cut rates. I kind of lean towards, if they can swing a 25 basis point cut, they will do that for the way it looks, both kind of as not incumbent or inhibiting on the incumbent presidency situation, what's coming down the pipeline for the election. I think that 25 basis point is the more safe route, but there is the possibility, the rising possibility, that weakening data could prompt a 50 basis point cut to be more necessary. If you enjoyed this video from the Market Insights Market Pulse podcast, you can listen to the full episode by clicking the link down below in the description. You can find us on your favorite podcasting apps, and again, we post several times a week, so if you're looking for market updates throughout the week, this is the place to be. Whether you're in the car on the way to work or something like that, make sure to tune in to get the latest. Thank you very much for watching. We'll see you on the next one.